From clean energy breakthroughs to new frontiers in space, the world is changing fast. But how can you invest in these game-changing trends without getting lost in the stock market issues? Welcome to Prosperity Pulse Point. Today, we're diving into a topic that's on every smart investor's radar: thematic ETFs. These unique funds have become increasingly popular because they allow you to invest in specific trends or industries, whether it's a booming clean energy sector, cutting-edge space exploration, or even advancements in artificial intelligence. But with so many options out there, how do you know which thematic ETFs are truly worth your hard-earned money? In this video, we'll break down some of the most promising funds you should be watching right now. We're not here to chase hype. Instead, we'll be focusing on solid data to help you make informed decisions. So, if you're interested in investing in the future while spreading your risk across multiple companies, stick around. By the end of this video, you'll have a clearer picture of which thematic ETFs might just be the perfect fit for your portfolio. Let's get started. Chapter 1. Understanding thematic ETFs. All right. Let's start by understanding what exactly a thematic ETF is. Unlike traditional ETFs that focus on broad market indices like the S&P 500, thematic ETFs are designed to target specific trends or sectors. Think of them as a way to invest directly in a theme you believe in, whether that's clean energy, space technology, or even robotics. Here's why they've gained so much attention lately. Thematic ETFs allow you to invest in emerging industries without the hassle of picking individual stocks. For example, if you're confident that solar energy will continue to grow, buying a clean energy ETF means you're investing in a basket of companies working on solar technology, rather than betting everything on just one. But here's the catch. While thematic ETFs give you targeted exposure, they also come with risks. Since they focus on specific industries, their performance can be more volatile compared to broader ETFs. If that particular sector faces challenges, your investment might take a hit. On top of that, many of these ETFs have higher expense ratios, meaning they cost more to own compared to standard index funds. That said, if you're willing to take on some risk for the potential of higher returns, thematic ETFs could be a great way to align your investments with the trends shaping our world. Chapter 2. Clean Energy ETFs to watch. Now, let's dive into one of the hottest investment themes right now: clean energy. With a growing focus on reducing carbon emissions and investing in sustainable solutions, clean energy ETFs have gained serious traction. Here are a few top performers that you might want to keep an eye on. First up, we have the iShares Global Clean Energy ETF, or ICLN. This fund is one of the most popular in the clean energy space, with assets under management of over $2 billion as of late 2024. It focuses on companies involved in renewable energy, like solar, wind, and hydroelectric power. Some of its biggest holdings include First Solar, Enphase Energy, and Vestas Wind Systems. What makes ICLN attractive is its relatively low expense ratio of 0.41%, allowing investors to gain broad exposure to renewable energy companies worldwide without hefty fees. Another strong contender is the First Trust Nasdaq Clean Edge Green Energy Index Fund, or QCLN. This ETF is perfect for those who are excited about the electrification trend. It holds companies across various sectors like solar technology, electric vehicles, and energy storage. Notable holdings include Tesla, ON Semiconductor, and Rivian Automotive. QCLN's focus on tech and automotive sectors has helped it capture the rapid growth in EV adoption. Its expense ratio is 0.59%, which is reasonable given its diversified exposure to multiple clean energy technologies. Now, if you're interested in a more specialized approach, take a look at the Invesco Solar ETF, or TAN. This ETF is all about solar power, holding companies that manufacture solar panels, electrical components, and provide installation services. Major positions include First Solar, Sunrun, and Nextracker. What makes TAN stand out is its focus on solar energy alone, making it an ideal pick if you believe solar will continue to see exponential growth. The fund also offers some geographical diversification, with less than half of its holdings in US-based companies. The expense ratio here is a bit higher at 0.67%, but it provides targeted exposure to solar stocks specifically. These clean energy ETFs aren't just about riding a trend. According to the Global Energy and Climate Outlook 2023, investments in renewable energy need to increase six-fold by 2030 to tackle climate change effectively. This means that clean energy companies are likely to see more capital inflows, potentially driving growth in the sector over the next decade. So if you're looking to align your investments with a greener future, these ETFs might be a solid way to diversify your portfolio while tapping into the clean energy boom. Chapter 3. Space Exploration ETFs to watch. All right, let's shift gears and look beyond Earth, quite literally, into the realm of space exploration. This is another thematic area that's capturing investors' attention as companies venture into satellite technology, lunar missions, and even future space tourism. While investing in individual space companies can be incredibly risky, thematic ETFs offer a way to tap into this exciting sector without putting all your money on a single stock. First on the list is the ARK Space Exploration and Innovation ETF, or ARKX. This actively managed ETF, led by the well-known investor Cathie Wood, focuses on companies involved in the development of space exploration technologies and innovations. The ARKX fund includes holdings like Trimble, Rocket Lab, and Kratos Defense and Security Solutions. What makes this ETF unique is its ability to adapt quickly. Being actively managed means that the fund managers can buy or sell positions based on changing market conditions. However, this flexibility comes at a cost, with an expense ratio of 0.75%. Next, we have the Procure Space ETF, or UFO, a fund that's truly focused on pure-play space companies. UFO invests in firms directly involved in satellite production, space imagery, and telecommunications. Noteworthy holdings include Maxar Technologies, Iridium Communications, and Virgin Galactic. This ETF is ideal if you're looking for targeted exposure to companies driving the future of satellite-based communications and space technology. However, be aware that its narrow focus makes it more volatile. The expense ratio is 0.75%, which reflects the costs associated with investing in a niche sector. If you're looking for a more diversified approach, consider the SPDR S&P Kensho Final Frontiers ETF, or ROKT. Unlike UFO, which focuses solely on space, ROKT covers both space exploration and deep-sea technology. This fund includes companies working on satellite infrastructure and autonomous space systems, like L3Harris Technologies and Boeing. With an expense ratio of around 0.45%, it offers a broader reach while still maintaining a focus on frontier technologies. It's important to note that the space industry is still in its early stages, and while the potential for growth is huge, so are the risks. For instance, we've seen companies like Virgin Galactic experience significant highs and lows. That's why using ETFs to diversify within this volatile sector can be a smart move. With countries and private firms investing billions into space missions and satellite technology, the long-term potential of this industry is hard to ignore. If you're someone who believes in the future of space exploration, these ETFs provide a way to invest in that vision without having to pick individual stocks. Chapter 4. Other thematic ETFs to consider. Beyond clean energy and space exploration, there are a few other thematic ETFs that offer unique opportunities in emerging industries. let's explore two that stand out in the current market. First, let's talk about the ARK Innovation ETF, or ARKK. This actively managed fund focuses on companies driving distributive innovation across multiple sectors. Unlike ETFs that concentrate on a single theme, ARKK takes a broader approach by investing in game-changing technologies like genomics, automation, and fintech. Some of its top holdings include Tesla, Coinbase, and Roku. What makes ARKK intriguing is its strategy to adapt quickly to changing market trends, thanks to its active management. However, this comes at a cost, with a higher expense ratio of 0.75%. For investors looking to capture growth in multiple disruptive sectors, this fund offers a diversified way to tap into several high-growth themes at once. Next up is the Global X Robotics and Artificial Intelligence ETF, or BOTZ. If you believe in the future of automation and AI, this ETF is worth a closer look. BOTZ focuses on companies leading the charge in robotics and AI, with top holdings like NVIDIA, Intuitive Surgical, and ABB. As automation continues to reshape industries, this fund provides a way to invest in companies that are making automation and AI a reality. The expense ratio is 0.68%, which is reasonable given the growth potential of its underlying holdings. Both of these ETFs offer exposure to fast-growing industries, making them great options if you're looking to diversify beyond traditional sectors while targeting innovation. Chapter 5. Key considerations before investing in thematic ETFs. Now that we've covered some exciting thematic ETFs, let's talk about a few key factors to consider before jumping in. Thematic ETFs can be a great way to align your investments with trends you believe in, but it's essential to approach them with a strategy. First, look at the clarity and purity of the theme. Make sure the ETF you choose truly focuses on the trend you're interested in. For example, a clean energy ETF that mostly holds utility companies might not give you the exposure you're expecting. Review the ETF's holdings to ensure it invests predominantly in companies heavily involved in the theme. Liquidity is another critical factor. Some thematic ETFs are quite niche, with lower trading volumes and smaller assets under management, or AUM. Low liquidity can make it harder to buy or sell shares at your desired price. For instance, an ETF with only a few $1 million in AUM may not be as easy to trade as one with billions. Cost is equally important. Thematic ETFs often come with higher expense ratios than traditional index funds. For instance, actively managed funds like ARKK can have expense ratios of 0.75% or more. Make sure you're comfortable with these fees, since they can impact your returns over time. Lastly, understand the risks and volatility. Thematic ETFs are often tied to high-growth sectors that can be volatile. Ensure that they fit your risk tolerance and long-term investment strategy. So, there you have it. A deep dive into some of the most promising thematic ETFs that you should be watching right now. From clean energy to space exploration and beyond, these funds offer a unique way to invest in the trends shaping our future. But remember, while thematic ETFs can provide targeted exposure to high-growth industries, it's crucial to do your own research and ensure they align with your financial goals and risk tolerance. If you found this video helpful, don't forget to hit the like button, share it with fellow investors, and subscribe for more content. Thanks for watching and happy investing!